Hello, good morning. I am Avnish Jain. Welcome to this monthly debt outlook from Canara Robeco. Let's have a look at the world news. The Middle East seems to have quietened down after a peace deal brokered by the US between Israel and Hamas, and the ceasefire still continues. On the other side, Russia-Ukraine war continues, though initial tentative steps have been taken to come to the negotiating table, with the US forcing both Russia and Ukraine to start talking. This may take some time, but these are the first tentative steps, which at this juncture, there is no clear timeline when it will happen, probably in the next few months. And this is the fourth year of war between Ukraine and Russia, and people would like to see that conflict to end. Coming to the US markets, US has been in a shutdown. What it means is that the US government, federal government, was shut down because the US government could not pay salaries and other expenditure for the US government to keep running. This happens because the US government spending has a ceiling which needs to be approved by the US Congress or Senate and passed by all the lawmakers. Once the ceiling is reached, any extra spending beyond that again goes for the approval to the lawmakers. The Democrats who are in opposition had taken a hard stance on certain issues related to insurance and immigration and were not approving the extra expenditure. After 43 days, finally some agreement was reached between the two parties and the government opened. However, in between, the markets lost a lot of data which used to come, especially linked to inflation, growth, and labor market. To that extent, the US Federal Reserve will have less data to work with when they meet, or the policy meet on 10th of December. A couple of weeks back, the December meeting rate cut was not clear, but the latest data shows, especially on the private data side, that there has been a large drop in sentiment, consumer sentiment, and sales are also down. Now markets expect a good chance of the US Fed rate cutting rates again by 25 basis points in December, after having cut 25 basis points in September this year. The US Federal Reserve has already cut 125 basis from last year, so it's a substantial movement from the rate cut cycle. And this rate cut cycle is likely to continue well into 2026. The US 10-year movement has been very less volatile this year as compared to past years. In early part of the year, in February, we saw US 10-year around 4.70 to 4.80. Now it is around 4%, which sees a large drop over the years with some volatility depending on data movement. Coming to India, Indian government has been unable to secure a deal with the US administration. US had imposed initially a 25% tariff on India. This was followed up by a 25% more tariff due to import of Russian oil by Indian refiners. US wanted to stifle Russia so they could come to the negotiating table faster. The deal is still awaiting approval from both sides. It has been going on for almost 10 months now. India was the first country to start negotiating in February with the US on trade deal. A lot of countries in Asia have got deals ranging from 15 to 25%. Clearly, India has been left on sidelines for various political issues, especially because of India's close relationship with Russia. Coming to Indian macroeconomic data, Indian economic data continues to be stronger. If you look at GDP numbers, GDP number for first quarter was 7.8%. Overall GDP for this year is expected to be 6.6 to 6.8%, which is extremely healthy considering the weaker global environment and also the US tariffs which have been imposed on India, which will lead to drop in exports from India. Inflation has been dropping fast this financial year. Inflation printed 0.25% for October 25, which was the lowest of this series which started in 2014. Overall, the inflation number is undershooting RBI's target by about 0.7%. RBI is well aware of the inflation undershooting their target, and in the last policy meeting, RBI Governor Mr. Malhotra did point out that there was some space for monetary policy action going forward. In a recent media interaction, RBI Governor reiterated that there is room for policy action and market therefore expect RBI to cut 25 basis in December policy, which is scheduled from 3rd to 5th, with the announcement of policy decision on 5th of December. Coming to markets, the market has been a narrow zone since last policy. If you look at 10-year yield, it has been fairly steady between 645 to 650 range, with no obvious direction given global uncertainties. RBI has been overcautious despite inflation going down and has withheld options to cut rates in this year. Inflation is expected to go higher next year, and that is the reason RBI has kept its rates on hold and stance on neutral. Going forward, the market sentiment will be driven by RBI policy action as well as any indication of future rate cuts beyond December. Markets will very keenly look at the monetary policy statement on whether RBI is also hinting for another rate move in the near future. We expect markets to remain range bound because of good economic factors like inflation being very low and growth remaining good and consistent. RBI has no hurry to cut rates because growth is on the higher side, but considering that the US tariff situation remains unresolved, RBI may have to take that step sooner rather than later. Even after this, we don't anticipate any major rally in rates. Rates may not go down too much. This is because, as discussed, we are almost at the end of the rate cut cycle where one rate cut or two rate cuts are maximum we are looking at. We have preference for short end of the bond curve as corporate spreads over G6 are there, and we prefer short to medium term duration exposure coupled with corporate bonds. Investors may choose to invest in funds like short duration funds, corporate bond funds, and banking and PSU debt funds. As usual, investors should look at their risk appetite and their investment horizon while investing in debt products. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.